or tiring. And I'm happy to be here today with Colliers, which I just asked before, just to reassure myself the fact that it's a firm with over 25,000 employees in Canada. And this is my second session today with a Canadian firm, so that's also interesting. Gentis was the first one 2 hours ago, which means that I'm here with the wrong mug today, but never mind. So I would like to say a couple of words. Obviously, we'll talk today about the opportunities and investment trends in the Canadian commercial real estate world in 2022. And just, so first of all, good morning to those of you in Vancouver and good afternoon, Toronto. Soon we'll figure out where each and every one of you is. A couple of words about our panel. I don't think I need to explain who Colliers is, but Adam Jacobs, where is Adam Jacobs? Hey, so Senior National Director heads Colliers Canada's research team, leading a cross-country team of analytics and research professionals, and holds a PhD in Sociology, featured a mainstream publication such as the Toronto Star. He specializes in the fundamentals driving real estate, demographics, the macro environment, and the global economy. And you are based?
I am based in Toronto. I'm happy to be here. I'm based in my living room right now, as I'm sure you can see. So
great. Jeremiah Shemes is here with us soon. We'll see him as well with his camera. Senior Vice President, ranked as the #1 investment advisor in the Greater Toronto Area in 2001, as well as top 20 in the country. His experience is with a vast array of building sales, real development properties, and land dispositions, has maximized value and mitigated risk for its clients. And where are you, Jeremiah, today?
Very good. Thank you for having me.
Thank you. And where are you in the world?
I'm in Toronto, downtown.
Are you all in Toronto? Maybe I'll save myself the question. No. Okay, so we're coming to James Lang, Vice President, works in, there you go, Vancouver. I was just there a couple of weeks ago. Lovely, lovely place, with one of Colliers' top performing investment teams, having transacted over $7 billion worth of land and investments properties since 2010. With his unique background in both financial analysis and land use planning, he has represented numerous international and national and private clients in helping them achieve their real estate goals. So hi, James in Vancouver.
Good morning.
Still good morning where you are. John Muzica, Associate Vice President of Real Estate Finance, built a reputation for sourcing competitive and creative debt and equity solutions for borrowers. His clients include prominent private investors, developers, and operating businesses. And where are you in the world?
I'm in Vancouver.
Vancouver as well. Great job.
Yeah.
So I think we got everybody. And of course, Colliers is a diversified professional service and investment management company operating in over 62 countries. And yeah, so I'm very excited to have you guys here with us today. And we will, I believe, open with an overview of the opportunities and investment trends in the Canadian commercial real estate, and talk about the environment and everything around it.
thank you, Danny. And thank you. We're happy to be here. Thank you for the opportunity to speak with you. It's obviously a fascinating time in the investment market. Every single thing is in flux at the same time, which makes it a little hard to analyze, but that's the time we enjoy. Okay. Like Denny said, I'm a big fan of the sort of macro outlook, the fundamentals, what's going on with inflation rates, demographics, and of course, then we'll drill into what's going on with the specific assets, multifamily, office, retail, what's going on with cap rates, and then maybe where is this all going, given that we're at a moment of such uncertainty. I put discussion at the end. Discussion does not need to be at the end. Please ask us questions. We're here to have a dialogue with you. I'm the research guy. The deal makers have incredible insight on what's really happening in these areas. Mine is more of a data view on this, but we're here to talk. I always like it when my email inbox provides me some good material to put on the first slide. Literally today, I got both of these emails in my inbox. PitchBook, which is a big service that tracks investor trends. Private investors are homing in on real assets. That's their number one story for this. Then we got our Colliers email about all of the biggest deals that we've done so far this year. One of them being the building across the street from us in Toronto, which was sold to a private investor for quite a healthy sum. So the private investors getting into commercial, I mean, they've always been there. They're not just getting into it, but as I can't open my inbox without seeing a story about this trend, and this is the moment for private investors to get into commercial. Okay, let's start with the absolute number one thing on people's minds, at least here. I don't think I'm breaking news when I say interest rates are going up, and that is a big concern, and interest rates will probably continue to go up. That is the one prediction I feel comfortable making. People ask me to speculate about vacancy rates and return to office. That's very hard to predict. We've been wrong a million times on that, but rates are going up. The inflation numbers were released yesterday in Canada. It pretty much guarantees rates will continue to go up. I just like to remind people it's happening rather quickly this time, but we do go through this cycle fairly regularly where the rates go extremely low, things get a little too hot, we raise the rates, it doesn't have an impact, we raise the rates again. This happened 5 years ago. It happened about 12 years ago. It's just, it's a cycle that comes and goes. However, I don't want to trivialize it. There is a little more risk this time with inflation, with the cost of living being much higher, and with the level of debt that a lot of people are holding. The other point is that although the official rate may go up 0.5%, the bond market is not obliged to only go up 0.5%. And what we're seeing is a pretty huge reaction to the bond market pricing in some of these future increases in a riskier environment. I looked at this yesterday. It was a year ago on this date, the yield was 1%. 2 years ago on this date, the yield was 0.4%. Now it's 3.4. So we are entering a different environment. I don't necessarily see that as a negative, especially for private investors. It's just, we've been in an environment where if you wanted to borrow a lot of money and leverage really highly, you were able to do that. And we may be entering an environment where that's not the case anymore. And people who have a little more cash on hand and don't need to borrow in the same way might find themselves with some pretty good opportunities. This is just to underscore that the loan environment is really changing, even compared to 8 or 9 months ago. It's quite a different environment in terms of what you need as a down payment, the capital requirements, and it seems pretty clear that this is going up, up, up. I don't know where it's going to end. In fact, I need to update this slide because it changes so frequently now. But this is all tied to the situation in Canada, and I suspect many, many other countries in terms of inflation. The mandate of the bank is to keep the inflation rate below 3%. We're at 14 months in a row where it's been above 3%. So they are going to have to keep doing something. There is no path here other than continue to raise the interest rates, and we need to get this back under control. I added in some of the labor market data, which I think kind of compounds the problem here, which is there is a risk of people's expectations catching up to inflation. Since there's inflation, I need a raise. Since I got a raise, it's driving inflation higher. Now that inflation's higher, I need a raise, and so on and so forth. And we get into a little spiral where it's very hard to break that. And there are some signs of that starting to happen. Initially, the data is a bit odd because when the COVID lockdowns happened, so many people with a minimum wage job lost their job that the average wage went way up. But really, it was just that like the work from home people were sort of left in the workforce. Then it went way down with the reopening, but we're starting to see the pressure coming up on wages. The labor market is getting quite tight, and it's influencing a lot of industries. There's quite a rise in job vacancies. We're seeing that reaching record high levels. 6% job vacancy rate. That's high. It's normally about 2 or 3%, even in a normal kind of booming, bullish type of economic environment. And this is a cross-country phenomenon. Sometimes we see these kind of stories and we say, oh, well, that's the oil patch in Alberta. That's very localized, or it's just like, it's an area that doesn't have a lot of immigration. That's an outlier. It really is across the board. You can slice and then dice it by by industry, by city, by province. Like this is an issue really everywhere if we're looking at the big environment. And it seems like an issue that's fairly likely to continue. They have the Bank of Canada has a survey. They ask businesses about the future of a lot of things. What are your expectations about prices, about hiring? And even in the sort of hottest economic environments, maybe 40 or 50% will say, yeah, I'm concerned that the labor shortage is going to be even worse in the future. Now it's 80% of people saying that. I think it's a real concern. We'll see if it turns around. These things do tend to have a cycle. It's not going to stay at 80% forever. But if we're looking at the sort of the labor market being tied to inflation and the macro situation and affecting some of these industries, it's a real concern right now. What's looming over all of this in the labor market is, of course, work from home. I always like to remind people, not as many people work from home as you think. We're aware of it because we work in a downtown office type of environment. There are many, many, many people who can't work from home, farm workers and hotel chambermaids and retail clerks and factory workers. It's not even a discussion, but you can see there's the risk of there are occupations where 30, 40% of people are spending most of their time at home. And if we're talking about office real estate, that's the biggest headwind right now. It's very hard to know if that's going to reach an equilibrium of people working from home forever, or if there's going to be a pullback on that. I think we're still working that out. There has been a much more momentum for return to office, though. This was last year. I can tell you, I was downtown in Toronto. It was just absolutely dead. We had data from a vendor saying, it was 95% empty compared to where we were pre-COVID. That's not the case anymore. Every city across the country has seen a recovery, has seen much more reopening. The last data I looked at for downtown Toronto is we have 6 times the occupancy downtown that we did at the same time last year. That will probably plateau in the summer. My view is sort of the main test of this is, okay, the kids go back to school on September 1st. Let's see really what happens then, because summer is always a little more slack in the office environment here. Okay, and before I get into the details of what's happening in terms of investment and cap rates of specific assets, I like to take the long view, zoom out, and remind people real estate has performed very well through a lot of headwinds and chaos. This is from Blackstone, which is the biggest private investor in the world. And they looked at all of their 10-year returns for all of their investments, and they truly do invest in everything. They buy bridges in India, and they take debt from Venezuela, and you name it. So they have a pretty big base of things to compare. And they looked at everything. How did it do each year? What was the high side? What was the low side? REITs, so real estate investment trusts, had the lowest downside of all of the assets they looked at, and yet still managed to have a fairly high upside. So it's kind of a happy medium of, you do not have the feast or famine. This is not the roller coaster of Bitcoin or anything like that, but you're still getting a fairly healthy return. So as people think about alternative assets, and they're thinking about them as, there's chaos in the bond market and stocks are losing a lot of value. I think there's many alternative assets. You can look at gold, and you can look at Bitcoin, and you can look at a number of things, but real estate still has a place. And if you think of everything that's happened in the last 10 years and all of the ups and downs, it's pretty remarkable that that's the area that's had the lowest downside for an investor. So far, so good. Okay, let's look at some specific things that are happening in Canada. And please, both co-presenters and guests, feel free to break in here or ask some questions or get some detail here. Let's start with office. Back in the good old days when I worked at a pension plan, office was the core asset, and this was the long-term play, and this is what everybody invested in. You got a nice downtown office asset and held it for 20 years. And indeed, I would say 10, even like 6 or 7 years ago, that's the way it works. The REITs and the big institutional investors buy the office towers, and they manage them, and they try to raise the rents a little bit. Then we went through a period where the gray bar on the chart is the REITs, the publicly listed companies. There was sort of a selling period during the boom. was maybe, prices were higher, or they were rotating their assets a little, buying things, something else. But what's really happened during COVID, and you saw my chart earlier, obviously rates were very, very, very low as they can possibly get during COVID. And that has catalyzed a lot of private investment. It's probably not the only reason, but what we've seen is a sort of unprecedented level of the private investor getting involved in the office market. Obviously in 2020, there wasn't a lot of investment or an office market or much of anything, but it kind of caught up in 21 and 22. Now, yes, there are a few big deals in there, like the one I highlighted at the beginning. That's kind of an outlier, but even still, this tracks when I talk to people in other markets, when I talk to people about the smaller deals, like the private investor is playing a large role. The only thing I'll flag here is, okay, the rate environment is clearly changing. It's getting hard to borrow. Probably some of those investors were leveraged heavily, some of them weren't. So the ones who are very dependent on debt, this might be a more challenging environment they're going into. The ones who are less dependent on debt, this might be a wonderful buying opportunity. Now, office is it's an asset class where you have to make your own call on this in terms of what is your feeling on return to office occupancy? How is this going to go? Are we just going to be back to normal in 2 or 3 years? I'm supposed to have an official view and prediction on that, but it's just still very up in the air, at least in Canada. I think it's still kind of, it's teetering on the brink, and it could go either way. I think some places it's become clearer that like return to office in some cities in the US is really a trend. I saw some data today that it was 80% back to where it was in 2019 in some cities in the US.
Adam, we've seen a pretty specific change in how investors are buying office. And I thought I'd add this anecdote, but people are looking for neighborhood mobility. So you have CEOs, centers of business who are choosing to change to have their office in kind of a suburb area or a neighborhood area rather than a financial core. So we've been successful in selling some of these suburban assets and these neighborhood-based assets where people want to be closer to their home, but they still want a separation between home and work. So this is like last year, for example, there was an increase of 116% of 25,000 square foot and below office building sales. So you see kind of people deciding, wait a second, I don't want to be in a tower anymore. I want to control my own destiny, deal with any potential lockdowns, deal with our own space, and get into a neighborhood where I'm close. So it's pretty interesting really to see that people are moving away from some of the larger scale office buildings into more neighborhood-based stuff.
And just lingering on your earlier point there, Adam, in terms of private individuals and private companies finding it more difficult to finance, I think that's really going to be key, because we're going to see a reversal in this chart likely in the next year or so here, because REITs and pension funds and insurance companies, they typically either don't finance and they use purely equity, or when they do finance, they do it through bond issuances that are much more efficient, especially for REITs, for example, where they can finance on a portfolio basis rather than on an individual property level. So they're able to see their equity stretch further than a private individual might, and therefore we'll probably see a bit of a reversal in this chart.
Yeah, that's an interesting point. Thank you. Regarding suburban office, I don't have all the leasing stats in here about, Colliers collects all its quarterly data on every market on A office, B office. But one thing I was looking at and discussing with a developer yesterday was the gap between suburban office and downtown in terms of vacancy is nowhere near what it used to be. In the heights of the bull market, suburban office vacancy was 3-4 times what it was downtown. That isn't the case anymore. It's coming much more in line. I'd say it's still higher in the suburbs, but in a weird way, the suburbs have kind of weathered the storm of this better, because it's a different asset. It's not as dependent on transit. That's the real obstacle, especially in Toronto, is the only way we're ever all going back to the office is if everybody gets on the subway again, and that not everybody is going to do that. So I could see the argument for some strength in the suburbs there. Okay, the construction picture, we had a huge boom, right, leading up to sort of right before COVID. We were at absolute all-time high levels. It's probably more accurate to look at this at like a market level, but if you roll up all the construction in Canada, there's a huge oil boom in Western Canada. So a lot of what was happening maybe 10 years ago was happening in Calgary. It's a bit of a hangover from that now. But what's happened in the more recent era, you see a run up from about 2017 to 2020, very centered in Vancouver and Toronto, very centered downtown, probably over 90% downtown, very centered at the top of the market, given land costs, absolute AAA, best of the best financial core type assets being built, and a lot of it, and performing pretty well. One thing we've seen during COVID is I just read our quarterly summary, and sentence 1, bullet point 1 is flight to quality is happening in the office market. These AAA offices are performing very well. Now the construction has obviously tailed off since COVID. It's not the same environment. And not only do we have the whole work from home threat, but the inflation, construction costs, labor shortage, all the trends I was talking about are really influencing what the sort of momentum for construction. Whereas I think 5 years ago, it made a lot more sense to say, look, if I look forward 2 or 3 years, I see nothing but blue skies. Let's just build now. Let's make this happen, and we're going to be happy when it's delivered. Making that decision in 2022 is difficult. So I think it's fair to say we're going to be in an environment with not, maybe still a decent level of construction, but not the run up that we were seeing beforehand. Okay, and then there's everyone's favorite asset class, industrial. Office and retail used to really be it for the big institutional and the sort of, that was the core holding of your pension funds and such. Industrial has really had a huge growth because of every trend in the world is a tailwind for industrial. Ecommerce is a tailwind, work from home, COVID, lockdown, you name it, everything ends up favoring warehouses, Amazon, Costco, industrial. Now, that being said, when we look at the same kind of chart, it's a different story. It's not about private investors buying in COVID. It's about private investors selling during COVID, and the big US and to some degree European, Chinese investor getting involved in Canadian industrial. That just wasn't the case 10 years ago. The GTA, sorry, that's our jargon for Toronto, warehouse market was not driven by the players I'm going to show you now. The number one acquirer for Canada Industrial in the last 2 years is that same private equity giant I mentioned earlier, Blackstone. Equinix is a US company that focuses 100% or 99% maybe on data centers. These were not players, 5-10 years ago in Canadian industrial, but there's starting to be a big appetite for it. It's a dangerous world. Canada is a safe place to invest. And the safest asset has been either apartments, depending on your view, or industrial real estate. So you've got a combination of, like, if you want flight to safety, if you want something where the future is still kind of bright for this asset and you're riding the wave, then Canada Industrial is very attractive. We have very, very tight market here, probably tightest market in North America for Vancouver and Toronto. Vacancy is well below 1%. It's getting below 0.5% in some of the markets. So it's a very strong market for an investor. If you're thinking about, can I raise rents? Is this a market with strength, even if there's a turnaround? Yes, it is. The other thing we're seeing is, if you're a big buyer from outside Canada, the prices look outrageous to us. Prices have gone up a lot. If you're cross shopping Toronto to Singapore, London, and Los Angeles, then maybe it's not that expensive. Maybe it's just sort of normal. So we were looking at these prices and saying, this is absolutely, an all-time record high. And they're looking at it and saying, yeah, well, compared to England, it's actually fairly affordable. So there is, if we're talking about investors with kind of a global view, and some of these do have that, then we have to be realistic that as expensive as Toronto is, as tight a market it is, and Canada generally, there's always a market that's even tighter and even more expensive. Do you guys want to, James or anyone, do you want to?
Yeah, it just comes back to lack of supply in terms of industrial land. At the beginning of COVID, land was selling about 3 million an acre for industrial. That stands at about 10 million an acre today. So when purchasing land at 10 million an acre, there's been a trend towards intensification of industrial land, multi-level industrial. Amazon was the first one to sign up for a 2-level warehouse in Vancouver here.
Mhm.
So, and the other trend that's going on is a strata market here in Vancouver where, individual industrial users are purchasing their real estate. The market's gotten so tight that it's a disruption to the business and people can't secure their real estate. So they're opting for the purchase option.
And I will say, I was just on a call with a Canadian bank about Toronto. I always say Vancouver trickles down to the rest of the country. And we had the Slido ask your questions live. And the number one question was, yeah, but what about strata industrial? This is all I hear about now in Toronto. So I guess that trend, I know earlier I said, oh, that's just a Vancouver thing. Perhaps not anymore. Perhaps that actually makes sense for the kind of occupier. Okay, and as I was saying, the price for industrial, especially during COVID, has gone up at quite a remarkable pace. It was already going up, of course, before COVID. There was, a strong e-commerce fulfillment center kind of boom, but it just was supercharged. And if we look at the rent chart for industrial, it will look pretty similar to this. I mean, you can argue it. As high as those prices are, if you look at the rent growth, it's actually maybe even like undershooting where we're going there. Rents, we just put out our quarterly stats. I think rents were up like 50% for Montreal year over year and 32% for Toronto. I mean, it's just absolutely crazy how the rents have gone up during COVID. And as goes the industrial sales market, so goes the land sales market along with it. Not everyone can buy industrial at those prices. Perhaps they can buy land and develop. I see those as, they're not exactly substitutes, but what's happening in one is basically driving the other. Do you guys want to comment on that? This is not the average price. This is just like the total dollars. So of course it's going up partly just because the price is going up, but we're seeing them kind of moving in tandem, the land market and the industrial market.
A good example to that, Adam, is that in Canada specifically, you have large global industrial players, and they're looking at areas like New Jersey and LA, where the rents are double for a modern high clear height industrial building of what they are in Toronto. So, quite specifically, they're just looking at where the growth is in the market and saying, why is New Jersey any different than Toronto for a number of different factors? So we're seeing a catch up to where the rents have been extremely low until really 2017 in Toronto, rents did not move at all. So it's just more of a catch up.
It also probably bears mentioning that Toronto and Vancouver are two of Canada's largest industrial markets alongside Montreal and Calgary. They are highly land constrained when it comes to industrially zoned land. In Toronto, there's something called the Green Belt, which is an agricultural zone that essentially constrains the city. In Vancouver, it's a combination of the ocean, mountains, and again zoning. So that it creates a lot more demand for that industrial land, and a lot of it is already owned by developers as a land bank strategy. So there's not a lot of available inventory, and the inventory that is available for industrial land is getting bid up quite significantly.
It's a policy change that's been constrained for years. And this happens in residential land as well, as I'm sure James can talk about because they have the mountains and the water. But in Toronto, we're so constrained because of how the policy changes held back the ability to actually develop anything. And on top of that, to Jonah's point, Toronto is the third largest industrial market in North America. So you really only have Chicago, LA, and New Jersey that are larger. So even on a U.S. scale, we're significant, which is causing a lot of backup in the need for land.
Yeah, it's helpful to have that context. I know we looked at what was under construction for industrial, and it seemed like a really crazy number. And then you compare it to these other markets, and it barely even registers because of the land availability. I think it was something like Dallas had 6 times the amount under construction relative to their inventory. So yeah, we're pretty hemmed in here in terms of the ability to build. Okay, and then there's residential. Residential has been a booming asset for basically forever. And in terms of land, prices have gotten very high. You could see in the total land sales, we had a big peak in 2017. There was big peak in housing, and there were some pullback measures, I would say, like additional taxation and cooling off of the market. Also, you saw the interest rate charts where there were some rises back to a more normal level, and that sort of cooled down the market for a couple of years. The market in 2020 was, pretty slow to non-existent, but now we are right back to it. I always hesitate with these charts because so little happened in 2020. It's maybe a little unfair to say 2021 is the best year ever, because it's really kind of combining like a year and a half. But even still, I think the trend is pretty clear. As hot as housing was, COVID made it twice as hot, because suddenly you can't go anywhere or do anything. And here I am working in my living room, and boy, it sure would be nice to have a home office. So what we saw in the sort of crazy run up in prices for housing tends to give people optimism about the residential land market. And it's been really, really hot of late. Although you guys can probably comment on this data lags. We don't have a full 2022. Whether that's changed in the last 6 weeks, I couldn't comment.
It definitely has changed the last 6 weeks. I mean, the interest rate pressure undoubtedly is, causing some turbulence in terms of, people moving forward and, transacting on land purchases. Combine that with construction cost increases over the last 18 months and construction material availability. There's been quite a sharp change in the amount of activity right now. Granted, the population and demographics support more construction, more people buying land, but we're at that juncture where everyone's just taking a little bit of a pause here and making sure that they don't make a mistake in terms of running their numbers correctly, in terms of making sure they get the municipal approvals, because there's more regulation today than there was 18 months ago. So it's a bit more of a challenging environment, but the long-term trend is still strong.
We actually have a complete contrast here in Toronto. And Toronto is 40% of the entire Canadian land market. So it's a pretty significant player. But effectively in the last 4 weeks, the entire market has stopped for residential land. And this is mainly in $20 million plus land sites. But we've had the perfect storm of policy and taxes come into place so that now pro formas are upside down in Toronto specifically. Outside of Toronto, in the greater Toronto area, there's still a fairly significant demand for development land, but it's really only in areas on transit and good location. So we've effectively seen this market stop. And a good comparison is to look at the residential housing market. The resale market had, I believe it was close to 60% increase in some of the suburban markets. Those markets are down now 30% since their highs, and they're continuing to move downwards only in the suburban market. Whereas in Toronto specific, the city, the housing market is actually up 1%. So you kind of have this conversing change where development land is still attractive in the 905 because the numbers are still able to make them. But in specifically Old Toronto and the city of Toronto, the development land market is effectively stopped in the last 3 to 4 weeks, and only deals under $20 million where private investors are able to capitalize on, having a significant amount of capital, deals are continuing to go. So it's actually weirdly a huge opportunity because owners are willing to transact at in some cases 5 to 20% off highs, but buyers are effectively stopped. So there are a few buyers buying because they believe that, just to James' point, the demand side of the economy is still there. So there's still going to be a need. And ultimately, as a residential developer, you're a service-based provider. You're just providing houses for people. So you still have 20% of the market buying, but other than that, 80% have stopped.
Yeah, this is probably the area most dependent on there was some change in municipal zoning or laws as opposed to some of these other asset classes we're discussing. Okay, as far as like rotating between the assets or the big picture, retail has been on the decline as long as I've been doing this kind of work. Like it's a story that's been around for, like, I don't know, at least 10 years, but it is quite clear that, like, retail investment is perhaps not what it was in terms of people are less interested in it. There are more headwinds in terms of, okay, obviously e-commerce and just the lockdowns and people's familiarity with online shopping and their hesitancy to go back to big environments. But you can see even before that, there was quite a decline. Retail used to be over 20% of the national investment market. Now it's more like 10%. And I would expect that number to maybe even go lower, with one caveat, which is, what if you're not buying retail for retail at all? What if you're buying retail for land, basically? And I think there's more and more stories like this, which is, we have a suburban mall and it's not that great. And it's probably not worth putting in tens of millions of dollars to make it really great. But we have a really big parking lot and a lot of land. And if we could just convince people that this is a good site for residential, for mixed use, for something other than retail, then we've really got something. And you're starting to see things transacting here where the point of buying the mall isn't the mall. And I would say that's the case in other assets also. Like there have been some, I just read my first story the other day about people buying hotels for the purpose of tearing them down and making industrial, because the hotel was right close to a rail yard and someone had the vision to say the hotel itself doesn't have that much value, but the land rezoned for industrial, now we're onto something. So I do think there's, you might see dollar volume still flowing in retail because of this whole redevelopment thing. It's just that's a complex long-term undertaking.
And Adam, I just add that in a micro fashion, again, in Toronto, in the Toronto areas, we're seeing a very large demand, actually a 16% increase from 2019, and then actually 6% increase this year from 2021 on neighborhood retail. And I think mainly the biggest reason we're hearing it is that some are saying we have no control over interest rates, recessions and driving demand. But if people find mispriced assets, and we're talking sub $20 million assets, where they can actually add the value to the real estate themselves, then it's within their control. So people are looking for properties that have been mismanaged. They're looking for properties that have tenants who have been in there for quite some time, where the mark on the market to the rents are below where they should be. And people are just taking properties where they can control the outcome of that and therefore add value that will ultimately create a cash flow that they can control. So we're still seeing an incredible demand for this. And in fact, some of the last properties we've sold, we've had almost 100 confidentiality agreements signed, which is, for those who don't know, that is like a significant amount of demand for a single retail neighborhood plaza. So I think what we're seeing is a shift in Toronto away from some of the things you can't control into areas where you can control by driving your own value into the real estate.
That's an interesting point. It's sort of the industrial strata in reverse in some ways. Thank you. I hadn't heard that actually. In terms of the assets, I don't think it's news that multifamily has become a very popular asset. This is looking at the ratio of office sales to apartment. 10 years ago, it wasn't even close, easily more than twice as much money flowing to office. Then by 2018-19, it's about 50-50. And now we're at the point where most of the money, if you were comparing those two, is flowing to apartments. It's not close. Now, that's last year. That's the depth of lockdown and work from home. That is probably a slightly unfair comparison point. I don't consider that line going to zero in the future. But I think the thinking of a lot of investors has changed about what is my core asset? What am I building on? Well, I have an office tower and I just, it's a 20-year investment minimum. Maybe the world has shown us that's a little more risky than we thought. And multifamily just has these tailwinds in terms of, we've been talking about how the residential market's completely crazy. Single family homes are up 60%. Well, people still have to live somewhere and not everyone can afford a $2 million single family home. in a weird way, that's quite bullish for multifamily. And we've seen dollar volumes way up. Again, 2021 is sort of a year plus, but still, it was an all-time high year. We're probably up 500% from where we were 10 or 12 years ago in terms of multifamily. And there's kind of the affordability issues that plague us with inflation, with the cost of living, even with raising rates. In a way, it's all favorable to multifamily in terms of, well, this is an asset class that is going to be even more in demand. People have a need for this. Perhaps the typical person who could have had a mortgage 5 years ago is now more of a multifamily tenant. And in addition to just the general demographic growth of population, you may even have a larger base of multifamily users than you had 5 years ago. So we're seeing the prices of that being driven up quite a bit, quite aggressive.
It also bears mentioning, just lingering on the multifamily for a moment. Canadian multifamily markets are somewhat unique globally because we have this agency, the CMHC, the Canada Mortgage and Housing Corporation, that is notionally responsible for contributing, I suppose, some stability to the multifamily markets for the benefit of Canadian residents. And the main way they do that in the commercial sector is that they insure lenders' loans against multifamily properties, which allows lenders to offer a cheaper cost of capital than they could for conventional loans. Typically, that generally ranges around 1% less than the indicative rate for, say, 5 or 10 year financing. You can get a 5 or 10 year loan against multifamily properties for about 1% less on the rate. That drives, obviously, greater purchasing power on the multifamily side. But one of the key elements that I would say aggravates that change is the fact you can get longer amortization. So because they're insured, you can get a 35, 40, under certain special programs, up to a 50-year amortization, whereas a typical commercial property would be set at 25. So all that contributes to significantly more purchasing power, more ability to kind of run through a value add process on multifamily, and therefore multifamily is a bit more of a supported and you could argue subsidized asset class in the commercial landscape in Canada than it is elsewhere.
Yeah, but we've seen a huge rotation of the private investor out of multifamily, and that accounts for a large amount of these transactions here. It's kind of a couple things that have kind of added to that. In Vancouver here and other areas of Canada, there's rent caps in terms of rental controls. So throughout COVID, the government set it at 0. So you couldn't raise your revenue. At the same time, insurance costs and property taxes were going up anywhere between 10 and 50% for some in insurance costs. So at this juncture, a lot of private families who had owned buildings since the 1970s, which is where the primary stock was built, rotated out, and that gap was filled by a lot of the pension fund clients, primarily based in Toronto. So we've seen a real institutionalization of the apartment world.
Absolutely. There's also been a sort of spillover. We see this for a lot of things, which is it's the same story in industrial. As the major markets become so hot, the definition of the market itself or where people are willing to invest starts to spill over. So Canada's highly urbanized, highly concentrated in big cities, but multifamily investment in the non-major markets is up a lot, even more than the overall multifamily trend. Okay, and then there's the topic of the other stuff. One I always like to highlight is life sciences. This is an area that Colliers does a fair amount of work in. It's a very expensive area to get involved in. You can imagine the details of lab space. It needs ventilation, cooling, all of this stuff. But from the landlord's perspective, we're talking about a tenant, they're thinking 15 to 20 years down the road. You've got something that few commercial landlords have. And just if we're talking about the fundamentals, this is a close to 0 vacancy type of market in a lot of cities. And let's not forget that we all have to put our money somewhere, and we may get tired of real estate or feel like the grass is greener, but some of these more speculative, shall we say, assets that people really got excited about during COVID, during an era where there was a lot of money sloshing around. It seems the reckoning is coming. I was hearing that to the chart on the right, I was hearing something the other day about, okay, the party's over for venture capital. a lot of this was really debt funded, and there's going to be a pullback. The tech companies have been living fat off of that. And so if we're thinking about diversifying, real estate is one alternative asset competing against these others. You know, the others aren't performing particularly well at the moment either. Okay, to speak to the fundamentals just a little bit more, the cap rates have declined in most markets. Calgary is always kind of an outlier. It is on a very different schedule than the rest of the country. It is the resource economy part of Canada. It is much more dependent on oil and gas than everywhere else. So it's kind of feasting and it's having a renaissance right now, but it comes and goes on a different cycle. But you can see the major markets, declines in cap rates, big declines for industrial cap rates. Industrial had the highest cap rate of any asset class not too long ago. Not the case anymore. I think we can, it's fair to say that's also a risk too, which is when cap rates decline that much and then rates go up, you can find yourself in a difficult situation. And if we're looking at the national cap rates, again, this shouldn't be surprising based on what we've discussed. Multifamily and industrial are where we've seen the biggest decline in 10 years, whereas an asset like suburban office, amazingly, is pretty much where it was in 2012. You could see that as an opportunity here. Here's a similar visualization of the same thing, but you can see the industrial cap rates have gone from on par or higher than the other asset classes 5 years ago to quite a bit lower. That's wonderful until borrowing rates exceed 4%, and then suddenly that's not very wonderful. So, and if we're looking at the market specifically, like I said, Alberta, which is the dark blue, is always kind of going its own way. Downtown office there especially is like a very different environment than we see in your Vancouver GTA type areas where the construction and activity is concentrated. Okay, I feel like I always like to wrap up on this because I feel like there's so much negativity in these presentations about, you know, the inflation environment and the job market and interest rates and everything is so terrible. If we zoom out to the planetary level, I think you can still make a very strong argument for the fundamentals. This was before COVID, you can see 2019, but COVID has messed a lot of things up in terms of immigration and all of that. But where we were is that Canada has by far the highest population growth in the G7, and, you know, not even close to these basket case Japan, Italy type things where the country shrinking out of sight. So it's about triple the US population growth. And you know, many of these asset classes are just ultimately dependent on more people equals more demand, and people tend to live in, you know, major markets, and that's going to keep backstopping it. I'm not saying any price is justified. I'm just saying ultimately it comes down back to the fundamentals. And yes, multifamily is up a lot, but if I look at this population growth trend, I think, yeah, it probably should be up a lot. It might even need to be up more. So we have a very strong demographic base in Canada. This is largely driven by immigration. The number one category of immigration is economic migrant, which means you're young, you have a university education, you speak English or French, you're ready to work in a professional environment probably. So that's the tailwind for office, for multifamily, probably even for retail or industrial e-commerce. So I think there's still a bullish argument here, even though I feel like the presentation has a number of negative points. Do you guys want to weigh in on anything as a summing up?
Yeah, without question, you know, the next 2-3 months are going to be a little bit slow in terms of, you know, sellers and purchasers are going to be a little, they won't be aligned on expectations. But at the end of the day, you know, real estate's a long-term play for a lot of our clients. And you just go back to demographics. Before COVID, Vancouver had about 35,000 people coming to the greater Vancouver region. Today, that number is 75,000. So the population growth is coming faster and more people are coming. So at the end of the day, that's what supplants the demand, the rents, and ultimately that's why it drives the cap rates down as well.
Agreed. I'm sorry, we do have a chat and people are able to weigh in or ask questions. I know we're most of the way through the hour. Do we have like an open it up to the audience section? Shall I speak a bit more? How would we like to do this? Just want to leave a little time at the end here.
There's actually a good comment in there. People need money and belief to buy and invest. Like, that's actually completely true right now. Right now, there's an understanding that they're not sure where rents are going, or rather rates are going rather. So you have a massive price discovery happening right now. So your bid and your ask are quite different in terms of where buyers and sellers are. But look, if you can take a piece of real estate that is mismanaged, inefficient, then you will always be able to create value. And that's the difference between the stock market and real estate. Real estate is extremely inefficient in nature. And so that's what people are looking for, who are truly able to continue finding good assets throughout recessions, is finding this mispricing of assets and creating very, valuable retail or office from mispricing of rents. And I think personally that those are some of the best clients who buy, and they take this opportunity to buy at 5 to 10% discounts from highs, but buying good locations where they can actually control what kind of value they're adding. Because effectively you're going to bucket yourself into two different types of buyers. And I know today we're talking about high net worth. So there may be some people on the call that are not actively engaged in managing the real estate, but there's a lot of really good talent out there that you can engage to help find these assets and actually manage the asset management for it. So, and I just personally think that even to James's point, if you look at the favorable outlook of Canada in the long term, you're able to find good locations and mispricing inefficiencies, then you can still find very good opportunities. But yes, right now you do need money and you need the belief to buy, because otherwise it's going to be an emotional response, just like the market when it drops.
Yeah, my view is just let's not overreact to COVID completely. I do think, it's just interrupted every single trend in the universe. I'm saying, from demographics to immigration to the office market, but it's so tempting to see it as the new normal. And I do wonder if we're going to look back on this as just one more sort of cycle, if a bit more extreme, and there could still be value in these areas like Jeremiah is talking about. Okay, storefront retail. Oh, this is dead. COVID has killed it. I'm not so sure about those kind of predictions. I think in 5 years, it's totally possible it could have gone the other way.
Neighborhood retail. Street front is not doing well.
I'm sorry, neighborhood retail.
Neighborhood retail specifically because it's a hedge for land. And so people in Toronto and probably Vancouver, James too, are understanding that if I can create an effective piece of land that is cash flowing, then I'm always going to be good in the long term. So, in the past, we had investors looking to, instead of buying bonds, they were buying a Bank of Montreal corner property, triple net lease with, a 14-year term on the lease. Now people are saying, oh, wait a second, the bond rate's at 3.6. So there's no point in me buying those low cap rates anymore. So now they're looking for neighborhood retail or neighborhood office that can be a sizable parcel of land that can be effective in the long term. And you're turning in raw land into effective cash flowing land for the long term. So for generational wealth and generational type families with large wealth bases, they're saying, okay, where am I going to put X amount of capital for the next generation? I want it to be effective when it's done, but I don't want to put capital into it in the near term. So they're looking for neutral cost-based cash flowing land where they can at least, hand this over to their kids, and 20 years down the road, the kids are going to own, this incredible located corner property or large parcel of land that can be developed into some kind of use. And that's where all these population demographics really come into play, because you're not making a pricing judgment on today. You're making a play on, okay, this is an extremely good neighborhood, already gentrified in certain areas, and there's going to be more density needed here, there's going to be more need for housing. So it's a service-based play in the long term.
From a debt perspective, it's also a lot easier to own something that cash flows for a longer period of time. So if you buy a greenfield site, for example, aside from any appreciation that might happen market wide, you're essentially losing equity for every year that you hold on to that because you have no cash flow to support the debt. So, there's an interest reserve involved. You'll have to refill that, or the lender will. Either way, it adds to your principal. And there's kind of a bit of a clock on the projects. Whereas, a shopping center, even an assembly of street front retail, if you have some cash flow there, you can service a debt pretty much infinitely, providing, you can manage that effectively and rents stay stable.
Sounds good. Let me see if there are always a few end of the deck slides that we can talk about. E-commerce is obviously like weighing over a lot, the same way work from home weighs over the office market, this weighs over the retail and industrial market. And COVID was the #1 fuel on the fire for e-commerce, but I do think we're starting to see a few, I won't say reversals of that. I wouldn't bet on e-commerce going away, but as things reopen in Canada, the numbers are not going up at the rate they were before. It seems to have kind of plateaued, and there is more of an appetite of, in my personal experience, e-commerce doesn't work quite as well as it used to. Now that everyone's using it, it's a little bit strained. Things take kind of a long time. They end up costing a little more than you think. So I do think there's an equilibrium between e-commerce is going to take over the world. We're going to buy every single thing on there. Retail is dead. Okay, we push e-commerce to the limit, and somehow we find that it's a little bit more convenient to just go down to the neighborhood retail thing and get what you need and not have to wait for it. So that's another macro trend that I think is kind of looming over this of, does this just keep growing to the sky, or is there kind of a new equilibrium we're at post-COVID that's higher, but not, doubling every 6 months level? I think we're pretty close to 1 o'clock. Let me just check the chat again. The other thing I'll say, this is my back to normal indicator, and this is a couple months behind, but still something I like to highlight, which is number of people traveling. To me, that is sort of even more than return to office. That's an indicator of like, is the world going back to normal, or are we all just staying in our basements forever? And I think it's pretty clear that the trend is now the world is going back to normal. This is data up to March, so it's going to be quite a bit higher, come this summer. If anything, we're struggling in Canada to deal with this. Like, oh my God, the airport is overwhelmed. We're not prepared for this level of people traveling. But it's hard to remember just how much it dropped. And now even last year, I took one trip last year. I know a lot of people who didn't take any on an airplane. We were still down 90% last year, and now we're most of the way back to kind of recovering to the trend line of, it does seem like people will ultimately get over this, and this is bullish for restaurants, hospitality, hotels, sports, name your industry, where the money is not all going to get sucked up by Amazon. There's going to be a rebalancing in this area as well. Okay. Is our host still?
Of course,
Of course, he's still here. Yes.
I don't talk because I'm listening.
Okay, I'm glad you're listening. Are we at the hour? Do you want us to keep going with the discussion, or?
We are at the hour and over. But if you'd like to add anything else, you may do so.
My view on this is nothing lasts forever, and that goes for inflation and rate hikes and all. This too shall pass, as they say. So I think it's a frightening time for investors, but there is going to be some limit of this. People always ask me, what's the limit? How far can interest rates go? I really don't know, but it's not just going to go up every quarter for the next 20 years. Like, there is going to be a turnaround of this also.
My kind of parting comment on the debt markets is, we're still seeing a ton of liquidity out there and a ton of confidence amongst lenders for the most part. So we're not seeing the kind of tightening you typically see before a recessionary period. There's still a lot of enthusiasm. Rates are clearly higher, and things still need to debt service, but I don't think we're seeing, fear add to the fire of rising rates.
Yeah, I think in the overall scope of things, while things seem turbulent right now, looking back at, various other times like that, this is where always the opportunities are. And this is where you look back and you said, I should have done it then. And that's where, you make money on the buy, not on the sell. So it's, one of the best markets to be looking because you don't have to compete in the same fashion you would have in the last 18 months.
I maybe think a little bit differently, but I think if you're buying pure assets, I think there's still time to wait because there will be more rises in the rates. And my guess is that the fall will be the right time to reapproach assets. The only difference is that if you're working through brokers, if you know of assets that have already been mispriced, where people are saying, oh, we're willing to take 10, 20% down, right? Those might be the markets to move on. But for regular priced assets, you're probably better to wait and to understand where rates are going to level off, because then you'll have a better idea. But that may take some time. So I don't know, Adam, what do you think? Didn't you have a graph at one point that was talking about where rates were in comparison for before 2018? Because I remember looking at the rates and we're not even at 2018. So we still.
Oh, you mean the bond? Yeah, hold on, let me pull up.
And so I always wonder, it's only the speed at which the rates are going up. And Jonah, you might be able to talk.
Well, yeah, I was actually going to pop in here. I mean, the overnight rate is only where it was in 2018.
Yeah.
But bond yields are dramatically higher than where they were in 2018. So we were seeing a lot of organic kind of volatility in the bond market that's driving it higher. And ultimately, borrowing rates are based off of bonds primarily, not the overnight rate, with the exception of prime-based lending.
Yeah, that's the paradox here is the rate itself is not particularly high in historical context, but then you look at the bond and it's like it hasn't been this high since summer 2008, which is a pretty crazy statistic. So there's a little more fear there than just the just maybe the rate hike would indicate.
But to your point,
it's priced in. Yeah, I don't know.
Yeah, it's priced in. And to your point, the velocity that's happened is definitely kind of the cause of most of the concern right now.
Exactly. It just happened so quickly, and it makes sense. The Fed's like, we need a reset on housing, and Bank Canada is probably thinking the same thing, following the Fed. And I think they're just thinking, let's get the pain over and difficult as quickly as possible. And so, to my thought, that is opportunity, because they're never going to raise this for the end of the world, right? And once that fear starts to lapse off, then you're going to see the market and that discovery start to settle. So in that time period, that may be only a 4-month period where there's still, certainly a large amount of fear, but there's still owners who are willing to give discounts and that rates are leveling off. So I think it's important to have your dry powder ready, to know what your strategy is, to know what type of asset you want to buy, know what your budget is, be working with your advisors to ready to go, and or be working to actually sell your assets. So it depends on which side of the coin you're on, but my guess is you just have to be ready to move as quickly as possible and follow where you think the sentiment in the market is better for an opportunistic, either on the selling or buying side. And I think personally on the buying side, we have time to wait. On the selling time, we're in last call at the bar, so to say. So there's not much more time there, but otherwise we're going to settle off and it'll be a 12 to 18 month discovery, but who really knows? It's hard to make any real prediction.
Maybe I will ask you just, a question from my point of view, because, our audience is normally very wealthy people that can handle, difficult situations better than others. What we've seen, and I know each city is different than one another. You just showed us that Calgary, how different it is from Toronto and other cities. But in general, what we've seen, we are broadcasting this from Rye in Westchester, which is an affluent area here. And what you saw, obviously, with COVID was that many people from New York, from the city, were running away to the suburbs when COVID came, right? Taking the rent and purchasing prices crazily, to crazy levels. But at the end of the day, these are people that had enough money to even buy at higher markets. So I guess at higher rates. So I guess you saw, a strong demand, which also, by the way, I assume influenced the office space, right? Because the further you live outside of the city, the less you want to go back to the city. And so my question is, did you see the same trend in major cities like Toronto? Again, the suburbs in cities like New York and LA are substantial, right? When it's like hours in the traffic to go there. It's not right for every city, but did you see the same trend in the major Canadian cities of the wealthy individuals saying, wait a minute, I can live and have a nice garden and enjoy that and taking the prices high? And do you see, and if so, do you see now that the people are saying, okay, now we can return to the city, or they're getting stuck there? Because what we see again is a weird situation where the interest rates are high. So people are thinking, wait a minute, should I buy this house now? And yet the house owners are not taking the prices down yet. So maybe, in real estate, you have a, several month delay until that. Obviously, you see that in the prices of the houses. So these are really my two questions for you.
They're not we actually saw the opposite. Like the hyper wealthy were going to live in Bahamas and Barbados, and they were renting and buying down there, Switzerland, Florida. Whereas more of the middle class and maybe higher middle class were going into external areas to say, I'm talking about, greater Toronto area. And that's why you said you saw this massive rise in housing prices, almost 90% in certain areas. Guelph saw 65%. So, and those markets have come off their highs by 30% because people are out in the suburbs, trying to get more space. And then they realize, wait a second, I have to go back to work. But some of our, more wealthy clients, they're like, we're going to Switzerland, we're going to Florida, we're going to Barbados, Bahamas, right? They have way more freedom. So they're able to look in much different external areas. But with that said, there was a certain segment of the market that were buying ranches, large cottages, and recreational properties and creating more of a home atmosphere in those environments. And so again, that's why you would see some of these cottage areas and, farmhouse areas, lake house areas seeing massive increase in pricing, but that's coming off now. People are realizing they want to be close to the city again.
But when you see those, by the way, wealthy individuals going to Switzerland and all, you saw many wealthy individuals moving from New York and LA here, I'm talking from the States, to Florida, only to find out that Florida is not New York, which is kind of, what can you do? You have palm trees, but that's about all you have. And some of them are, even the restaurants and all the lifestyle they built for us here this is not it. And some of them are maybe have second thoughts. I'm not talking about the taxation rates there and all of that, but just moving. So you don't see that families moved from Canada to Switzerland or Bahamas or wherever and saying to themselves, now that I'm here for 2-3 years, it's not my thing. Or do you think they'll get stuck there?
They're seasonal. So we saw a lot of the seasonal approach, like for instance, Palm Beach in Florida is basically, New York with sandals, right? Like it's like, tons of New Yorkers down there, lots of wealthy, Toronto, and there's still really good restaurants down there. So it became a cultural hub in certain specific areas. A lot of people we saw go to Switzerland were more, worried about the taxation rates. So they were, actually moving their assets out there. And then the other ones going to some of the islands in the Caribbean, for them, it was a seasonal based decision too. Mm-hmm. So, it was generational asset, family wealth looking for areas outside of Canada where they could spend warm months instead of being in the winter in Canada. So it's a little different in Canada than it is the US probably, but in the same way, people were just looking for convenience and cultural and weather.
I'll just add, we definitely have data on this and COVID's effect on the overall migration trends in Canada is quite noticeable. That the logic beforehand was everyone leaves the small towns, moves to Toronto to get a job, get an education, whatever, make it big. That has reversed. People can see this slide, right? This was one of the hidden slides. Mm-hmm. Yep. Nova Scotia, if you're an American, think Maine or something like that. Maritimes, shipbuilding, some, good education, kind of a slower lifestyle. Generally, people leave Nova Scotia and they come to Ontario to, make more money or have more opportunities or live the big city lifestyle. And that has really reversed. Like if you're talking about like wealthy people cashing out of the big city and moving for the country life, this is one of those indicators where we're seeing like, your house might be at an all-time peak in Toronto, cash it out for a couple million, take that to the Maritime Canada, and if you were rich here, you're really rich there. If you have that kind of money, it's a much slower lifestyle, much, different quality of life. Whether there's going to be the pullback, I personally think there is. All the people who moved, 1,000 miles away because they're going to work from home forever. I'm starting to hear the first stories of, oh, but on social media, all my friends are having fun and going to the baseball game and seeing concerts and enjoying the waterfront. And I'm sitting here in the country at my laptop watching Netflix. So I'm not sure how that one's going to play out, but we've definitely, when we look at the data, the rush away from unaffordable places to affordable places was a big trend. And I don't know if that's the rich so much as like the middle class and upper middle class who became rich through, I bought this house for a couple $100,000. It's worth 2 million. This is a once in a lifetime opportunity. I can't earn 2 million, but I can cash it out here. So we're seeing that in a lot of these trends of it, and it's having effects in those markets as well. The average house price in Halifax is up a lot more than the average house price in Toronto. So Halifax being the Nova Scotia major city.
And the interest rates and the fact, like you said, that they're starting to go back to the city. Do you see the sellers are getting that and are lowering the prices, or like here, still very firm asking price, therefore less deals?
It's going to take a while to adjust. Typically price indicators lag by 6 to 12 months. So I don't think any vendors have really adjusted their expectations yet. But eventually, you'll accumulate enough sales of people that had to sell that didn't have a choice. They had to take whatever price the market was willing to bear, and that'll set a new standard, and vendors will get educated.
It happened in 2013 in Toronto in the industrial land market. You had 2010 rather, because of the great financial crisis, a lot of the industrial land and employment opportunities kind of fell off the wayside. And then you didn't have industrial land pricing get back to highs until 2016, roughly, even 2017 in some cases. And that's because most landowners decided, okay, well, I want $800,000 an acre, and now it's $600,000 an acre. I'm just not going to sell, right? Because their cost base was so low, they decided to hold on. So it's all about the staying power. And to Jonah's point, you will get some, having to sell, but most landowners have held for generations. To my point about holding good parcels of land with income, and they have, income, they have some kind of lease basis, they're making some money, but their cost base is so low. So they really have no issue just staying there and waiting out the storm.
Yeah, I think the first people would start to see dispose of sites that are going to be developers. Typically, they're not as well capitalized. They typically, either syndicate or they have loans that they just can't afford to bear for long periods of time. So they can't afford to sit on a site for 10 years without income. So they'll start to move if they can't proceed with their project.
Thank you. Great. First of all, I have to tell you, and I'm not just being nice, I've done over 200 of those sessions, and this was one of the most fascinating one. And I want to thank Colliers for coming up with the idea of having such a diverse team that can give us the different, feelings of different cities. Normally, when we have real estate presentations, it's like a macroeconomic outlook, but here we could really feel the difference within the main cities in Canada. But by the way, Calgary is our next one. We are today in Vancouver, Montreal, and Toronto, and Calgary hopefully would be our next one next year. So so I would like to thank you all for being here. We've been here for 1 hour and 20 minutes, which is very impressive. I see there's a question here at 2:17. Okay, we'll take that question. What about climate change factors?
I think we're personally seeing a reverse in this, because all of a sudden you had everyone wanting to work on these ESG factors, and then you're having, the discounting of pricing, like oil costs coming up so much. So people are now back on coal. I mean, anyways, for some of the investors we deal with, they're saying this doesn't make sense unless there is an economic benefit to us. Everyone wants ESG, but they don't want to let go of their pocketbook. So it's really only the pensions and the institutions that are able to deal with, effectively moving an entire portfolio out of oil into different asset classes. So I don't know what's going to happen there, but my guess is that people are going to worry about their pocketbook first and then deal with the ESG things, which is, maybe sad in a way, but I think that's what happens when you deal with recessionary times.
Yeah, I think the only thing we see in Vancouver, because we're, close to sea level here, and there's certain clients of ours who actually have more of a global risk strategies around, sea level rise and avoiding certain areas where, they're susceptible to that. And it's a long-term vision, but, it is something that is becoming more prevalent as, our weather systems change and, there's more flooding. I don't know if anyone saw on the news, but, the entire city of Abbotsford was under about 10 feet of water back in November because of what they call atmospheric river. So, these are things that people are starting to think about when they make real estate decisions.
And I'll say for Canada, one thing that we have going for us in that is it's sort of a tale of two markets. There's an oil patch and everything, but Quebec is probably the biggest clean energy jurisdiction in the world. It runs 90-something% on dams and hydroelectric power. And there is a great appetite in that if you are some kind of data center industrial type asset and you need a lot of power, and you will need a lot of power for a long time, Quebec is ready to make you a deal. So Ontario runs on nuclear, which is no emissions, and Quebec runs on hydro. And I think that's a benefit in terms of people who are running these power intensive businesses. Data centers comes to mind, but there's manufacturing and other ones. There is an advantage for Canada compared to a lot of jurisdictions there.
I'll just end by mentioning insurance is probably going to be the driver for any kind of climate related decision making in commercial real estate. We saw that to James's point with the Abbotsford flooding. We see that regularly in interior BC, which typically has very dry summers, and fire risk is significant, and we regularly get fires. Tens or hundreds of thousands of acres burn up. And, periodically you do have challenges getting insurance, or insurance rates are dramatically higher than where they should be. And that does have an effect on pricing, on interest levels by buyers. So I think we'll probably see that lead the charge in terms of people's decision-making related specifically to climate change.
Thank you. So
Thank you, Denny. It was a lot of fun.
it was really fun. James, I wonder how it is to wake up when all of us are already been working for 3-4 hours, but it's just because we envy your weather, really. I mean, I'm sorry, it's just whenever I see people on the West Coast, they're always smiling more than us here on the East. Anyway, thank you so much. It's been a pleasure seeing you guys. And I'm looking forward to hopefully do another session like this in person or online later on down the road.
We'll be there.
This session is recorded for those of you who asked me here, and we will send the recording exactly. You're going to get it exactly 24 hours after this session. So tomorrow at 1 EST, you will all get the link to the session, and those who registered and haven't seen it will be able to watch it. And those who've seen it and want to watch it again, will watch it again. So thank you so much, and looking forward to seeing you again.
Thank you.
Thanks, Eddie.
Much
Thank you,
appreciated.
everybody. Bye-bye.